Okay guys, so what is Forex? Forex is the biggest market of its kind in the world, trading around $5 trillion a day. So Forex in short is the currencies market. And FX trading or Forex trading is therefore being able to predict the fluctuations in the price movements of the currency pairs, which in essence are the exchange rates. The currencies are quoted in pairs. So if you imagine when you're going on holiday and you're exchanging your pounds for dollars, for example, the exchange rate is quoted on the FX market as the bid and the ask price, which we will cover later on in the course. But in short, it is the value of one currency against another.
Welcome to your first pair. Now, some of you may have come across charts such as this before, but for many of you, this is the first time that you're seeing a Forex chart. Now, we as traders spend a lot of time analyzing these charts, so it's very important to make yourself familiar with the charting software and all of its features. Now, as I mentioned, for many of you, this is the first time that you're seeing these charts, so I don't want to throw you guys straight into the deep end and overcomplicate things. I just wanted to introduce some of its basic features so you can understand exactly what's going on. So now we're looking at a currency pair. In this case, we're looking at the GBP against the USD. That is the British pound against the US dollar. So the currency pair is always quoted on the top left-hand corner here. The price is dictated on the right-hand side. So all this is showing that at its current price, every pound that you exchange is worth $1.27. Now the time frame is at the bottom here. I'm not going to go into time frames too much because we cover this later on, but just so you know, the time frame is covered at the bottom here. Now in the middle of these charts, what you see is Japanese candlesticks. In its simplest form, all they show, if they are green, that shows that the price has increased within that time period, and if they are red, it shows that the price has fallen in that time period. Now, as we can see, the price does not remain static. It is constantly fluctuating in value. Now, there's various reasons as to what makes the market move, but ultimately it is the buyers and sellers that are moving the market. Okay, so when we look at these candlesticks, we can see clear trends that are forming. This is a clear upwards trend. This is also known as a bull trend. Okay, so in its simplest terms, in practice, all this means is that the pound has strengthened against the US dollar. So if we look at this low point here, you will only need $1.26 for a single pound, as opposed to when it's trended upwards, you would now need $1.33 to get a single pound. So let me just highlight this for you very quickly so you can see what a bull trend looks like. It is an upwards move. Now, on the other hand, if we're looking at a bear trend, this is a downwards move, which shows that the pound has weakened against the US dollar or decreased in value. Now, a good way to remember these two kind of trends, the bull trend and the bear trend, is to imagine how these two types of animals actually attack. Now, when we're looking at a bear trend, you can imagine that a bear attacks with its claws, and it attacks from an upwards to a downwards manner, whereas a bull attacks with its horns and attacks from a downwards to upwards manner. Now, it's important to note here that it is the first quoted currency within the currency pair that you're actually buying or selling. So if you're speculating the pound to increase in value, then you would buy that market and you would expect this upwards move. Now, if you were speculating the pound to devalue or weaken against the USD, then you would sell that market and expect this downwards move. Now, because we have the availability to do both, that is buying the market and also selling the market, that presents us with a lot more opportunities throughout our trading day and our trading week to be able to make profitable trades. As opposed to, take for example, traditional stock investing. Okay, yes, now you can short stocks, you can short cryptocurrencies and make a profit as a result, but traditional stock investing relies upon the stock increasing in value, and that is the only way that you'll be able to make a profit. Whereas with Forex, you can make profits from buying the market and also selling the market, and you'll find yourself going both long on the market and also short on the market throughout your trading journey. Now, as I mentioned before, there are various reasons that cause the markets to move in the first place. But volatility is actually good in the markets because we as traders only make money through the fluctuations in these price movements. Now, economic factors such as unemployment rates and interest rates can have an impact on the pricing of currencies also. Also, political factors and the amount a country exports or imports can have an impact on the pricing of a currency as well. Now, sometimes governments will purposely print money in order to devalue a currency. So you're probably thinking, why did they do this? Because when they do this, more money is actually in circulation, but you can imagine everything still costs the same. So it devalues or weakens that price of that currency. Now, one of the main reasons to devalue a currency is to boost a country's exports, as it now will become cheaper for other countries to buy your products in your weakened and devalued currency. So say, for example, you are a farmer, okay, and you export potatoes to Dubai. Okay, now pre-Brexit, the exchange rate was about 5.6 dirhams. Okay, so for me to buy a potato, it would cost me 5.6 dirhams to buy a single potato. But now with the weakened pound, the exchange rate is around 4.8 dirhams. So now that potato is only going to cost me 4.8 dirhams. So buying from the UK now becomes more attractive to me. Also, bigger political events such as the recent Brexit can have bigger and even longer lasting impacts on a currency, as reflected in the huge drop of the pound after the recent polls. So let me try and show you this. If I can scroll all the way back to June 2016 when it happened, I'm just going to show you what kind of an impact that can have on a currency, and you'll be able to spot it straight away. And there it is. As you can see, that is a huge drop, okay? Unparalleled to any other drop or gain that you can see before it. Okay, so the market, as you can see, did not move much before it, but as soon as Brexit happened, you can see that drop. Okay, it fell all the way from 1.50 all the way down to 1.32. As you can imagine, that is a huge drop. The British pound has never really recovered as a result. It's tried to peak up, back up towards the 1.44 levels, but again, as the Brexit talks get nearer, we're seeing it drop back down towards the 1.27 levels. So these factors are known as fundamentals, but many traders will only trade off technical analysis purely from the technical analysis of the charts, which we will cover in depth later on in the course.